Thanks for tuning in to this broadcast of The Resilient Advisor. My name is Jay Coulter, and joining me for this episode is Sean Walters, who is the CEO of the Investments and Wealth Institute. As a SEMA holder myself, I'm excited to have you on today, Sean. You guys are releasing a new study here in the next couple of weeks entitled Defining the Future of Wealth Management. Your team was kind enough to send over an advanced copy. I love the way it breaks down the dynamics and trends that you guys see unfolding over the next decade in both wealth management and amongst investors. And I think listeners and viewers of this broadcast are really going to appreciate this content. Sean, thanks so much for coming on.
You bet, Jay. Glad to be here.
Now, I know that your team's been working hard on this survey and report, and I've been, but just share with listeners a little bit about your background and your association with the Institute.
Yeah, so I've been with the Investments Wealth Institute, formerly IMCA, as you know, since 2007. I came over from the Financial Planning Association, where I was at from really 1997 until 2007. As you may know, that group was itself went through a name change. Before 2000, it was two different associations, and I came in from the International Association for Financial Planning. So that's really how I got into this industry, was all the way long time ago, different century, millennium, in 1997, when I joined up as a director of membership for the Financial Planning Association and was responsible for a lot of their programs surrounding membership and international growth. And at the FPA, I was in charge of all their conferences, publications, their sales efforts, all the knowledge management stuff. And then in 2007, came over to IMCA, now the Investments and Wealth Institute, and really started to work on our conferences, business lines. We've done a lot since then. I became CEO in 2010. So this is my 10th year as CEO of the organization. And really excited to talk with you about some of the stuff that's going on for us, and particularly how the knowledge keeps evolving and how the profession keeps evolving. And that's really what this report is about.
Excellent. You know, as a SEMA holder and a CFP holder, I get questions from the field quite regularly about which designation I prefer or which one somebody should pursue first. And I try and be very neutral about it. I love both designations. The body of knowledge is different.
Yeah.
Me, myself, Sean, I'm a nerd. I loved the portfolio construction and the math behind the SEMA designation. For applications in financial planning, CFP has some weight. You guys also have some other internal designations there at the Institute around wealth management. I'm curious, how do you answer that question?
That's a great question. I think I usually answer the question with a question, which is, what are you doing at your firm? What is your, how is your advisory team structured? What type of clients are you serving? What's the strategy for your firm in the future? And I think that really should determine what it is which advanced capabilities or which, fundamental capabilities an advisor gets to make themselves more valuable to their team and to their clients. And then, of course, there's just passion. Like you said, there's some folks who are really passionate about retirement planning. They may not be doing that within their function as much as they would like to. So they build that skill set through retirement management advisor, or one of our designations, to just be able to learn more about it, because that's what they want to learn about. So it really does depend on the firm, what services it's delivering, the role that you either currently play within the firm or want to play, and then building out those capabilities to deliver upon that.
All right, so let's talk some specifics then as it relates to the designations and bodies of knowledge that an advisor could go after inside the Institute. So the SEMA, for folks that are interested in the investment consulting side and portfolio construction. Retirement Management Advisor. Tell listeners a little bit about that program and what the outcomes are.
Yeah, so the Retirement Management Advisor is about a 12-year-old program. We acquired it, I guess, closing in on 3 years ago, 2.5, and have done a lot of work on it. And it's slated to have a job analysis next year. And we'll probably talk about what a job analysis is in a moment. But right now, the focus of the Retirement Management Advisor is to help advisors learn how to put in place a process to address a client's retirement plan. So looking forward, some designations focus on the retirement income products that are out there. Some kind of take the retirement planning sleeve out of CFP and just put a designation on top of that. RMA really comes at it with a unique process-oriented approach that looks at a household or a family as having a household balance sheet, much like a pension plan, and then addressing that balance sheet with a variety of ways, including documenting all the procedures that you're making in the retirement recommendations. So it's kind of a step-by-step procedural and process-based designation that digs into just that retirement client's needs. And it focuses on those needs first and then builds out a plan to address those needs. So I think it's very different than what's out there. It's very agnostic in terms of the product solutions that will be in place for a retirement client. And it focuses on the process and the client.
All right. So then with your certified private wealth advisor, could you contrast that with the CFP designation?
Yeah, we've actually, the group of volunteers back in 2007 that put together the original blueprint or what they wanted to teach, they were all CFPs. And they really felt as though the CFP curriculum only takes you so far in dealing with a lot of the issues that the high net worth client, expects from their central quarterback advisor. And so, as you can imagine, there's some overlap, right? You understand tax and investments and estate planning and all those, having a core body of knowledge of CFP certainly helps a candidate get through CPWA more successfully. But then it gets into closely held business structures. It gets into concentrated stock for executives. It gets into retirement issues and estate and charitable planning issues that CFP doesn't really get into. So it's really designed to take that CFP foundation and build upon it into almost like a master's program where you're focusing on a high net worth client and their needs.
That's exactly how a friend of mine described the program. It's like a master's level class for the high net worth and ultra high net worth market space, as opposed to the broader reach and depth of the CFP program. Is that a fair statement?
Yeah, I think that's fair. You bet.
Awesome. All right, so let's talk about this report. What was the genesis for this and some of the background and work that went into it before we dive into the details?
Yeah, so one unique aspect of a certification body is how we determine the standards under which you're certified. And so CFP does this the same way. CFA, you do it through a job analysis survey. You kind of go out and survey professionals in a field and ask them what knowledge and skills are most important in their day-to-day work. And that keeps it agnostic. It keeps it objective. It's not some professor in some university saying this is how the world should be, and you're going to learn this, and I'm going to test you on that.
And who's never, ever sat down with a client before.
Yeah, exactly. That's exactly it. So it's really practitioners driving what practitioners should be able to know and do. And they're kind of stale reports, to be honest. It's a bunch of ratings around different knowledge and skill statements. So when we did the SEMA job analysis in 2018, and then we did the CPWA job analysis last year, it seemed like an opportunity to kind of look at those two bodies of knowledge in a holistic way, but then also to pair them up with what are some other trends that we know are happening in the industry. Research we've done on clients, for example, research we've done on advisors, and research that we've heard from industry executives. So the report really is attempting to summarize all of those different trends that are happening within the industry, within clients, and within advisors, and then tie that to the knowledge and skills that are required for our certifications, so that you can kind of see how we're kind of keeping pace with the change that's happening in the advisory profession or the wealth management profession. And that's probably one big thing, Jay, that as I was looking at the data, when we first came out with CPWA, I thought we might be planting the flag on this is what wealth management is. It's serving a high net worth client, 5 million and up. It's these knowledge, it's these skills. Fortunately or unfortunately, I think wealth management has been defined as broader than that. And I think it does include investment consulting. I think it does include the financial planning process and financial planning. Like what seems to be happening in our profession, and I use that term purposely, I think financial advisor is a profession. I don't think financial planning is a sub-profession. I think it's just all one thing. And sometimes organizations try to carve out ground that consumers don't see as being different. We're just financial advisors, and hopefully we're going to help them meet their goals. So this report does try to integrate how wealth management teams, how financial advisor practices, you can use those two terms interchangeably, present services to the end user. And those services are typically financial planning, investment advice, wealth management, so kind of high net worth client services, private wealth services, and retirement management. And the next iteration of this report, of course, will be when we complete that RMA job analysis later this year. Mm-hmm. And then we'll kind of have that comprehensive wealth management body of knowledge, all those puzzle pieces coming together. Does that make sense?
Yeah, makes perfect sense. And for listeners and replay viewers, you can download a copy of the report once it's live by going to the Institute's website that can be found at investmentsandwealth.org. That's investmentsandwealth.org. In the draft that I have, you guys are outlining 61 different skills, tasks, and capabilities that are really required. For this broadcast, let's not go as deep into that because they can get that from the report and you'll find it fascinating, listeners. But what I really found interesting is some of the findings as you were looking at dynamics and trends that you see unfolding in the industry. Yeah. So if I could start with the wealth management industry, which is one of my favorite places to focus on, one of the first things you found is that the number of advisory teams are shrinking. What were some of your takeaways from that piece of data?
Yeah, and I like the sometimes one sentence says it all, because there's a mixed data out there about whether the number of advisors is shrinking or increasing. And some of that is, how do you define an advisor? So that's why I kind of like this takeaway is that from the research we've done and from talking to industry executives, is that whether or not the number of advisors is increasing or decreasing or staying relatively the same, because if it's increasing, it's up 2%. If it's decreasing, it's like down 1%. So it's pretty static, I would say. Everybody agrees. But through consolidation, the number of teams or units that are delivering wealth management, financial planning, financial advice, that is definitely shrinking. RIA firms are consolidating. That's like a mega trend right now, and forming bigger teams. Even within the large banks and brokerage houses, wirehouses, they're pulling together single advisors into teams. And so those teams are shrinking, meaning the number of them, but the number of advisors on teams, of course, then is growing, because you're going to see larger teams shaping in the advisory world, doing more complete set of services, and relying on technology more to service, a broader set of potential clients.
One of the notes in the report that stood out to me as an investment guy is you talk about, investment management being table stakes. And that it always irks me when somebody talks about investments being commoditized. We're at the top of a bull market. I mean, I remember in 1999, you were an idiot if you weren't in indexes. In 2007, you were an idiot if you weren't in indexes. Yes, there are ways to capture beta through passive vehicles, but sophistication is what's going to help clients weather any coming storms. And you guys even point out that that's the evolution of advice, the more sophisticated investment management tools, resources, and strategies that the high net worth clients especially are going to appreciate in the coming years.
I think that's spot on. I agree with you, Jay, that I think the last 9 years have made some, even advisors, a bit lazy about the investment management side of their capability set. They rely on ETFs, they rely on indexes, or their firms model portfolios, to do the work of investment management because everything's up. Mm-hmm. They don't have to think too hard. I think there's a risk there for advisors, particularly, because when you survey clients, that investment management is the number one service that clients expect, from their advisors. So if you're outsourcing that or you're downplaying the importance of that, just remember those clients at the end of the day, they do value financial planning and wealth management, retirement management, all those services. But the number one on their list, and it's probably because this is the way most advisors charge for services, is that there is investment management. And so you better have that blocking and tackling or ground game or defense, whatever analogy you want to use with the Super Bowl coming upon us. You better have that in good shape, or else, you're going to face some hard times.
Yeah, that's right. You actually commoditize yourself by making the investments commoditized. And I'm a big believer, listeners know, in having a financial planning centered practice. But as the data shows in your report, the clients still care about the investments. They're important. Another thing in your report that stood out to me is that the next generation of Robo is here, and you see it unfolding. When the first generation of Robos came out, I wasn't concerned about it, because if you're providing real financial advice, a Robo is not a threat. But there's a change in dynamic that you guys found here in this report. Tell us a little bit about it.
Yeah, I think it becomes more and more a tool as part of the advisor's toolkit, and less a threat, as it originally, in the term Robo Advisor was, I think, designed to scare advisors into reading the articles about how technology is reshaping the advice delivery business. But I do think it's an opportunity, and those advisors or firms or teams that see it as such are, they're not having to turn away clients, for example. I've had relatives that I've tried to, recommend to an advisor, and there's minimums for how much assets you can have to work with an advisor. And I think technology is changing that. Now firms can interact with all kinds of clients on all types of issues. The one thing, Jay, I would tell as a story, I was with another small credentialing group. So a bunch of executives like me that work with credentialing bodies, certification bodies. And one of them was in the medical field. They, that software can diagnose cancer faster and better than an oncologist. So what is the oncologist there to do? Well, the oncologist is there to take that data, take that knowledge, and do something with it. Not for that first line, does this person have cancer or not? Because software can certainly make that diagnosis now. And the knowledge behind what's in software packages is still going to be incredibly important for knowledge professionals like financial advisors. They have to know what's behind those ratios that they're reporting or reading in a software package. They have to know, what's behind all of the different data that's going to be reported as part of a model portfolio or a retirement plan. So I think that the knowledge professions become more valuable as technology checks off, some of the, let's say, more fundamental tasks that have to be done within a wealth management practice.
I love that story and that analogy. In fact, there's probably some way that advisors could repurpose that story in conversations with their clients when they say, hey, why don't I just go to Vanguard? Because being able to decipher the data and manage through, especially if we have another downturn in the market, be able to make sure that clients, stay on track so they can meet their goals. Something else in your report that no report is complete without a discussion around fees. Tell me what you guys see unfolding as it relates to fees in the wealth management space.
Well, it's a tricky one. So right now, there is kind of margin compression within the industry as a whole. Product providers, asset management firms are having to deliver products that are lower cost. And that's having its effect on broker-dealer firms who then put those products on their platform are making less off of those products. So it's margin compression happening at the, let's call it the manufacturing side and on the distribution side. And then the advisors who are running all these storefronts are there saying, we're not affected by this. We still charge what we charge our clients. We have a wide array of services. We're really good at what we do. So we're going to keep charging what we've always charged. In fact, because the products are cheaper, we can now show our clients that we to them. So fees have stayed pretty flat for the advisor community, while behind them, the big banks, brokerage houses, insurance companies, distributors are getting pinched by margin compression, and particularly the asset managers. So here's, I think, the question, and I don't know if this is the answer or not, but one of the questions we just keep exploring with our board members and our industry executives and advisors is, if there's a recession and a downturn, consumer expectations are certainly up. And this margin compression has kind of flowed through all the way up to the gates of the advisor's practice. I think we're starting to have some concern that will flow into what the client expects from the advisor. And just to give you an example, I serve on a board that oversees a 401k plan. And as you know, there's a lot of those boards are in the news in lawsuits because they didn't do their fiduciary duty to make sure that the investments were prudent for their employees. So what do boards do? Well, they look at the lowest cost options and say, at least we're providing a low cost option, so we're making a prudent decision. And those low cost options are very cheap. So as more clients work within those retirement plans and start to apply those expectations to an advisor, it's possible that they start to expect the advisor to bring down their price to match those expectations. I don't think it's happened yet, and I'm not sure it's going to happen anytime really soon, but I think advisors are going to need to do a better job of explaining their value proposition, of articulating the different services that a client needs and the cost of those services or the value of those services. And I think that's the way they'll be able to kind of hold off this consumer expectations are up and fees are facing downward pressure kind of mega trend.
Sean, I'm fortunate in that I've been able to build an audience, with the podcast and with social media. And, with any audience as it grows, you'll find the negative boo birds when you post certain things. And there are three things that bring out the negative comments and the keyboard heroes. Number one, suggesting that cap-weighted indexing is going to create a problem for your business if there's a market downturn. Number two, most hedge funds that you have access to are not going to deliver what you think they're going to. Get the negative comments there. And the biggest one is suggesting that the AUM fee model might not be around at the end of your career, and you might need to consider some of these alternatives that are grabbing market share.
Yeah,
I have some experience with the XY Planning Network and what they're rolling out to these younger generation of planners with retainer-based pricing, and it's catching fire. And I think some of the advisors who are long in the tooth like myself are going to get caught by surprise. Did you guys find some of that in your data?
Yeah, I think so. I didn't XY maybe do like an income-based fee model, based on the income that you're earning as a professional. The subscription-based model, you've seen kind of Schwab throw that out there with their subscription-based planning model. I think you're right. I think it needs to be more of a mix of different revenue sources, not and putting all your eggs in the AUM basket.
Mm-hmm.
Or if you do, at least kind of carve that up a bit, I think is not a bad idea to kind of show the value. And I'll give you another example. In our world, the association world, for 100 years, we just charged an annual membership dues payment. And you got access and education and advocacy and community for, $400 a year. Well, today, all the choices professionals have for knowledge, community, access, name it, there's little bite-sized pieces all around the internet and all around advisors wherever they work. And so we've slowly seen the membership society model has slowly seen that value proposition go away. So we've had to think about, what are we charging for? When we charge a membership fee, what are we really charging for? It's discounts on conferences, it's access to publications, it's subscription-based. Even how we communicate subscription-based value, I think we're going to have to change over the next couple years. And you'll see that we're already in the works of planning for different ways of charging for value to ongoing education, content, and really relevance. That's what you come to an association for, is relevance. Because you have access to content everywhere, but what you don't have as a professional is access to relevant information that's designed by people like you, for people like you. And that's where professional associations, I think, still hold their value.
Yep. Excellent. So I try to keep my podcast around 20 minutes. We're already at 25, but I can't help it, Sean. I could talk about the industry with you for hours. I want to touch on some of your findings on the investor side before we wrap up.
Yeah.
My favorite takeaway is the fact that the greatest value is investment management expertise still. And I want to repeat that. The greatest value found by this survey is still investment management expertise. Sean, what else did you guys find as it relates to dynamics and trends that the investors are looking for going forward?
Well, I think quickly, there's still ethics and expertise at the top of the list in terms of the characteristics that clients want out of their advisor. They almost assume that is the case, that they're ethical and they have knowledge. But then there's 4 other characteristics that kind of separate advisors that are exceptional from advisors that clients see to be good. And those are personalization, exceptional client service, delivering advanced capabilities, which kind of swings right into our wheelhouse. And what was a meaningful guidance, which I kind of lump in with the whole behavioral finance movement, right? So it's got to be meaningful, protect me from myself, and focus your advice on things that are important to me. Mm-hmm. And I think those 4 characteristics are key.
Yeah, I got to tell you, Sean, this report is fantastic. Listeners, when it should be out in the next 2 weeks, they're targeting. Go to investmentandwealth.org to get a copy. If you're an active podcast listener and you have not listened to the Exceptional Advisor podcast that the Institute puts out, I highly recommend it. It's right in the wheelhouse of anybody who is tuning in to the Resilient Advisor. And if you're looking at some designations, you guys have heard me say it before, I'm a huge fan of the body of knowledge I acquired with the SEMA designation. It's fun to get into the mathematics of portfolio construction and applying the behavioral finance, but also check out the other designations from the Institute. Sean, I really appreciate you coming on the Resilient Advisor podcast.
Yeah, anytime, Jay. Great talking with you.